Most people who lose money in trading don't lose because they're stupid. They don't lose because they picked the wrong coin. They don't lose because the market is rigged. They lose because of something much harder to see. They lose because of what's happening inside their own head. Welcome back. This is episode 1 of our trading psychology series. And today we're going to talk about something that almost nobody wants to talk about. The psychological side of trading. Why your own brain is the biggest enemy you'll ever face in the market. Let's start with something uncomfortable. Your brain was never designed for trading. Your brain evolved to keep you alive in environments that no longer exist. Avoid the predator, run from the unknown, stick with the group, protect what you have. These instincts kept your ancestors alive for hundreds of thousands of years. But in a trading chart, they will destroy you, because trading rewards the opposite of survival instincts. Trading rewards cutting losses fast, sitting through discomfort, going against the crowd, risking what you have for an asymmetric outcome. Everything your brain wants to do in a trade is almost always the wrong move. And honestly, most beginners don't even realize this is happening. They think they're making rational decisions, but they're not. They're being driven by survival circuitry that's millions of years old. Now let's talk about the 3 emotions that destroy more accounts than anything else. Fear, greed, and FOMO. Fear shows up when a trade goes against you. Your stop is fine. Your thesis hasn't changed, but you feel the drawdown and your body reacts. Your heart rate goes up, your hands get tense, and suddenly you're closing the position early, just to make the feeling stop. You didn't exit because the setup invalidated. You exited because the discomfort invalidated you. Greed is fear's twin brother. Greed shows up when a trade is winning. You're up 30%. The target was 40, but you keep adding to the position. You move the target higher. You ignore the signals telling you to take partials, because the dopamine feels good, and you don't want it to stop. And then there's FOMO, fear of missing out. The market is pumping. Everyone on your timeline is posting screenshots. You weren't planning to trade today, but suddenly you're chasing a candle that's already up 12%. You're not buying because of structure. You're buying because you can't stand being left out. These 3 emotions, fear, greed, FOMO, they're not character flaws. They're features of being human. But in trading, they will quietly bleed your account. There are 2 biases I want to talk about specifically: loss aversion and recency bias. Loss aversion is the simplest one to understand. Losing $100 feels worse than gaining $100 feels good. Roughly 2 times worse. The studies are very consistent on this. So what does that mean for traders? It means you'll hold a losing trade too long, hoping it comes back, because closing it makes the loss real. And you'll close a winning trade too early to lock in the gain, because watching it tick back down feels unbearable. Loss aversion is the reason most beginners have small wins and giant losses. The math is backwards from what trading requires. Recency bias is even sneakier. Recency bias means your brain weighs recent events much more heavily than older ones. If you just had 3 losing trades in a row, you'll feel like the market is broken. Even if your edge has worked for years, if you just had 3 winning trades in a row, you'll feel invincible. Even if you got lucky on entry timing. Both feelings are lies, but they feel like truth. And that's the problem with biases. You don't notice them while they're happening. You only notice them in hindsight, after you've already acted on them. One major difference between beginners and experienced traders is emotional expectations. Beginners expect trading to feel exciting. Professional traders expect trading to feel repetitive and disciplined. That's a huge difference. Most beginners are emotionally attached to being right, catching every move, making fast money, looking smart, posting wins. But professionals focus more on risk management, consistency, emotional control, following systems, surviving long term. And honestly, professional trading is usually much more boring than social media makes it look. A lot of people online show huge profits, crazy leverage, emotional excitement, fast wins. But sustainable trading usually looks very calm. Professional traders understand something important. You do not need to win every trade. You only need good risk management, consistent execution, emotional discipline, and enough patience for your edge to play out over time. That mindset changes everything. Because now, trading stops becoming emotional gambling and starts becoming process-driven. Let me describe a typical first year for a new trader, because this story repeats almost every single time. Month 1. You discover trading. You're excited. You read everything. You watch hours of YouTube. You join Discord groups. You feel like you found a secret door that most people don't know exists. Month 2. You start trading, small size. You win a few. You think, this is easier than people said. Maybe you're naturally good at this. Month 3. You size up. Your first real loss hits. You're confused. You revenge trade. The loss gets bigger. Month 4. You blow up your first account. Not your last account, your first one. You sit with the loss. You promise yourself you'll do better next time. Month 5 and 6. You study harder. You find a new strategy. You're more careful. You think you've learned. Month 7. You blow up your second account. Different setup, same emotions. Month 8, 9, 10. You start to realize maybe the problem isn't the strategy. Maybe the problem is you. This is the moment where most people quit. But the people who don't quit, this is where their real education begins. Because they stop trying to find better setups. And they start trying to fix what's between their ears. There are 5 mental traps I want to mention. You'll recognize all of them. Almost every trader has fallen into all 5. Trap 1. Anchoring. You bought a coin at $5. It's now at 3. You can't sell because you paid 5 for it. But the market doesn't care what you paid. The market only cares about now. The $5 price is an anchor in your head. It has no meaning to anyone else. Trap 2. Farm. We already talked about this one, but it deserves its own slot because it shows up everywhere. Not just in entries, but in choosing strategies, choosing assets, choosing communities to follow. Trap 3. Revenge trading. You took a loss. You're angry. You don't wait for the next setup. You force one. You size up to win it back faster. You're not trading the market anymore. You're trading your emotions. Revenge trading is responsible for more blown accounts than any other single behavior. Trap 4. Sunk cost. You've already invested time, money, attention into a position. So you keep holding, even when every new signal says exit. Because exiting would mean admitting the time you spent was wasted. But here's the thing about sunk cost. The money is already spent. The time is already spent. Holding longer doesn't bring any of it back. It only adds more cost on top of cost. Trap 5. Confirmation bias. You take a position. Then you only read news that supports your thesis. You only follow accounts that agree with you. You filter the market through what you already believe. This is comfortable and dangerous. Because the market doesn't care what you believe. The market only does what it does. So if there's one big lesson from this episode, it's this. Most traders do not fail because they lack information. They fail because emotions interrupt execution. And honestly, this is why trading is so psychologically difficult. Because the market constantly tests your patience, your confidence, your discipline, your emotional stability. And if you don't understand your emotions, you start reacting instead of executing. One thing I want people to remember is this. The goal is not to become emotionless. That's impossible. The goal is to recognize emotions without allowing them to control decisions. That's a massive difference. Because even experienced traders still feel fear, still feel stress, still feel frustration. They've just learned how to manage those emotions better. And honestly, that skill matters more than most people realize. So to summarize today's episode, we talked about the biggest lie traders believe, that more strategies automatically create profitability. But the reality is a good strategy means nothing if emotions constantly destroy execution. We walked through the neuroscience of why your brain works against you: fear, greed, and FOMO, loss aversion and recency bias, the difference between beginners and pros, the typical first-year journey, and 5 common mental traps. At the end of the day, trading is not just a technical skill. It's emotional management under pressure. And the faster traders understand that, the faster they usually improve. Now in the next episode, we're going to talk about one of the most dangerous emotions in trading, FOMO, fear of missing out. We'll break down why traders chase pumps, why social media makes FOMO worse, how emotions peak near market tops, and how professionals avoid emotionally chasing the market. And honestly, I think almost everyone listening will relate to that episode. Appreciate you all for listening. If you enjoyed this episode, make sure to subscribe and share it with someone getting into trading. And I'll see you guys in episode 2. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.